Hello everyone and welcome once again to your own channel Easy and Effortless Economics. So in the previous video we have discussed about the accounting concepts. So in the same way we are going to continue with the accounting conventions and accounting principles. They all are interconnected. But let's quickly understand the difference between conventions and principles. Basically, conventions are defined as the guideline which helps the companies to determine that they have to record certain business transactions that have not been fully addressed by the accounting standards. So these conventions are used for this purpose. Then what are the principles? Principles are basically the rules that set like what has to be done. Now, let's understand the definition. Accounting convention are certain restrictions for the business transactions that are complicated and are unclear. Although accounting conventions are not generally or legally binding, these generally accepted principles maintain consistency in financial statements. So as I have already told you that there are certain things which have not been defined by the standards. So for that purpose, these conventions are used. So how many types of conventions are there? Basically, there are four main types of conventions. They are conservatism, consistency, full disclosure, and materiality. So we are going to discuss each one of them one by one. The way to remember them is C2FM. C2FM. You by this acronym you can remember this. This is how I remembered. So I'm sharing the same trick with you. C2 conservatism, consistency, FM full disclosure, materiality. So this way you are not going to forget. Okay, so let's discuss each one of them individually. Starting with the first one, what is conservatism? It says that when the accountants are revealing the information, when they are giving the estimates for the assets and liabilities, they have to make sure that the value that is lower out of the two should be considered. Two values like the book value and the market value. So whichever is low, that has to be considered. It tells the accountants to be on the side of caution when providing the estimates for the assets and liabilities, which means that when there are two values of a transaction available, then always the lower one should be referred to. So the lower value has to be considered. Next is the consistency. Consistency means stability. So once the methods that have been adopted by the organization or the business should not be changed immediately, or there is no scope for changing the method, because that is really difficult for the organizations to cope up with the changes every now and then. So it says a company is forced to apply the similar accounting principles across the different accounting cycles. Once this chooses a method, it is urged to stick with it in the future also, unless it finds a good reason to perform it in another way. In the absence of these accounting conventions, the ability of investors to compare and assess how the company performs become more challenging, because if the methods are not going to be the same or they are going to be different, so it is really difficult for the investors to assess the actual position of the organization. Third one is your full disclosure. Information that is considered potentially significant and relevant is to be completely disclosed regardless of whether it is detrimental to the company. Means the information that is in the interest of the people, or that it should be in the interest of the investors, has to be disclosed completely. There should not be any hiding or anything that should not be missed out. Then is the materiality. All the information that is related to the material facts or the material aspects of the company has to be disclosed, because on the basis of that the entire decision is going to be influenced. So it says similar to full disclosure, this convention also bound organizations to put down their cards on the table, meaning they need to totally disclose all the material facts about the company. The aim behind this materiality convention is that any information that could influence the person's decision by considering the financial statement must be included. Means every information is provided, so that provides a good option for the investors or for the people who are willing to invest into the company, so that they could have a complete and detailed information about the organization. So that were the conventions. Four conventions: CCFM or C2FM. Now coming to the principles. What are the principles? It says accounting principles are a set of guidelines and rules issued by accounting standards like GAAP and IFRS for the companies to follow while presenting or recording the financial transactions in the books of account. This enables company to present a true and fair view of the financial statement. It is required for the organization that they have to disclose everything, and it has to be done in a systematic manner. For that purpose, these accounting principles were evolved. The two bodies that were engaged in setting up the accounting standards are GAAP, that is generally accepted accounting principles. This set of guidelines is set by the FASB. Financial Accounting Standards Board, and second is IFRS. It stands for International Financial Reporting Standard. So they set the rules and the regulations and which they expect the organizations to follow. Now coming to the principles. There are total 6 principles that you have to understand, that how many concepts are there, how many conventions are there, and how many principles are there. There is segregation of all of these terms. It should not be considered as one. That is why I am covering all the 3 perspectives. So the first one, as you can see, is the accrual principle. What is that principle? Basically, this principle is the concept, or this principle says that you should record or the only the accounting transaction in the period in which they actually occur, rather than the period in which the cash flows related to them occur. Means when recording, this principle says that when recording the accounting transaction, it should be taken into consideration that the period in which they actually occur, that is considered, that will be recorded, rather than the period in which the cash flows related to them occur. So this is about the accrual principle. Then your consistency. Consistency principle says that the same pattern or the same policies or the strategies that have been adopted by the organization should remain the same. They should remain strict to that, so that there should not be any difficulty, or it should not be going to be very challenging for the investors to analyze or assess the position of the organization. Then third one is your conservatism. It says that it is a principle that requires company accounts to be prepared with caution and high degrees of verification. What sort of verification it is talking about? That all the losses, all the probable losses are recorded when they are discovered, and the gains can only be registered when they are fully realized. Suppose if the company is expecting some sort of profits or gains from some source, they cannot record it unless they have received. And in case of losses, if they have discovered any of the losses that may happen, so they have to record that. So that is your conservatism principle. Then is your going concern principle. Going concern, as the name suggests, it is very simple, that the organization or the business remains the same. It does not stop, or it is not affected by anything that comes in between. It keeps on working with the same pace. New things came to it, new additions are being done to the organization. Many things left out, or many things have been left far behind, but still it keeps on moving with the same pace. Then coming to the matching principle, what it says? This says the matching principle instructs that an expense should be reported in the same period in which the corresponding revenue is earned, and it is associated with them. Suppose the expense have been done but revenue has not been received, so there should not be any entry for them. Entry will be done only for the expense the revenue has been received. So for that purpose, there should be matching between the expense and revenue. And the last one is your full disclosure principle. So as the name says, it is very clear. The organizations have to disclose everything that is in the interest of the investor, or that is in the interest of the people, because it provides them an outline and understanding, or better understanding of the things, or they can easily analyze the situation of the organization. So these are the 6 principles that we have covered in this topic, and the 4 concepts that we have, the 4 conventions that we have discussed. In the previous, we have covered concepts, now conventions and principles. So this topic we are completing with this one, and in the next lecture I'm going to take up accounting equations. So stay tuned, keep learning, keep smiling, and keep sharing your love. Thank you everyone. God bless you all.